how to invest. Let's assume that you have been saving money and have an extra $1,000 in your bank account. That is already an achievement because nearly 70% of Americans don't even have an extra $1,000. How do you invest your first $1,000? To understand what investing is and how does it works, consider this example. Let's say you worked so hard and saved $300,000. You can pay a visit to a Ferrari store and get yourself a luxurious car and let everyone know how successful are you. Or you can buy real estate and rent it out. Every month you will receive at least $2,000. If you decide that you no longer want to keep receiving that $2,000 paycheck every month, you can sell it and get back your initial investment. In fact, the value of your investment might even appreciate, so you will sell it for a higher price. And that's how money makes money. But you can't buy real estate for $1,000. That's not even enough for a down payment. However, that doesn't mean you can't invest that $1,000 elsewhere and let it grow. The easiest way is just to deposit it into a savings account and generate interest. But why would the bank pay you for keeping your money in the bank? Shouldn't they charge you instead? No. You see, the bank is going to take your money and loan it to someone else at a higher rate and would share with you a portion of that profit. That's how banks work in short. The only problem with this strategy is that interest on deposits account is so low that it doesn't worth it. The highest rate you probably can get is 0.8%, which means that if you invest $1,000 into a savings account, 12 months from now, you will receive an extra $8, which is extremely low because the Fed targets an inflation rate of 2 to 3%, which means if you're not getting at least 2 or 3%, over time, the real value of your $1,000 will depreciate, which means you can buy with it less goods every year. But why interest rates are so low on deposits account? Because interest rates in general are low this year, since the pandemic forced the Fed to lower them to encourage everyone to borrow money and spend. A year or two from now, once we get out of this recession, the Fed will increase interest rates to 1 or 2 or even 3%, which means interest rates on savings accounts will rise as well. Your second option is to buy government bonds. A government bond is a security that's issued by the government to raise money to support government spending. Say the government wants to build a school, but it doesn't have the money to do that, so it issues an IOU, a piece of paper that says whoever owns this security is owed this much of money plus interest by the US government. Of course, this is an oversimplified example, but that's the point in short. Government bonds are heavily influenced by interest rates. So, since interest rates are extremely low this year, government bond rates are less than 1%. But 2 years ago, when interest rates were high, government bonds rates were as high as 3%, which is not bad since the government bonds are the safest investment you can ever make. Any investment carries with it a certain level of risk. If you're loaning money to the US government, what are the chances that the US government will default on its loan? For the US government to go bankrupt, the entire US economy might have to fail. That's why US government bonds are considered the safest investment in the world. But if you want to make a higher return, let's say 10, 20 or 30%, then you have to consider investing in the stock market. For example, Amazon's stock price increased by over 80% just this year. Google's stock price rose by almost 30%. Tesla's stock increased by 721%. Yes, you heard that right, 721%. Then the question is, why would anyone invest elsewhere when they can double or even triple their money in the stock market? The answer is risk. When it comes to government bonds, for example, there isn't much risk. In fact, it's risk-free to a certain extent. But when it comes to individual companies, there is a risk that the company might fail. It might report negative earnings. Pretty much any negative news can drive the stock price down.